I have with us today on the line Byron Mccann. He is a charter member for Keiretsu Forum Northwest. He joined many, many years ago. He has also been in the early stage investing space for a very long time. Is very passionate about clean tech and works with other investment groups in the Seattle community. So Byron, I'm going to go ahead and turn the meeting over to you. And thank you so much for being here.
Great. Thanks, Brianna. I'm glad to be here. And thanks to Keiretsu for all the awesome stuff you guys do. So my name is Byron Mccann, and I changed my thing here to say Seattle. And what I'm passionate about is liquidity. And I don't mean just at the bar. I mean also, when you invest, really looking forward to getting liquid on an exit so you can turn around and, do it again. So Brianna asked me to talk about this, so thank you to her for reaching out. And anybody on this audience that's done a number of investments and seen them through, is probably very aware of nuances of term sheets. So I may not be saying anything new. What I'm really doing is giving you my perspective from my experience. I think the term sheet keys, it's got to work for both the company and the investor, because essentially we're partners in creating value for each other. And so some of these are important for both. And you got to really seek a balance in a term sheet. It can't be too company focused. It can't be too investor focused. It's got to be somewhere in between that's healthy. And then, Brianna asked me to, what are my top 5 things that I look for in a term sheet? And I'm not an attorney, but I've been through a number of deals, and I'm going to share with some of my experience. Just before I jump in, my background is, I've been an entrepreneur in a number of startups with exits that have had angel and or venture rounds. Currently, I'm the CFO of Rowan-Tells, which is a tech-enabled services company in the intellectual property and anti-counterfeiting space. And we're venture-backed and have done a number of rounds. So, I'm still on that side of the table as well as on the investor side. So I like to think of myself as balanced. Others may disagree. And then, I've been the CEO or COO or general manager of startups that have had exits. And I've done a lot of M&A and strategic partnering with Ascent Partners. And I've been a venture partner with Prism Capital, EMY telecom consultant, and I actually did some schooling. And like Brianna said, I'm a member of Element 8 and the Keiretsu Forum, and very happy to love the camaraderie. And every time I meet with my colleagues, I learn something new. So my my focus for this presentation is, this is my own personal view. I'm not a lawyer, as I said. I've been on both sides of the table. And these are things that I look for besides valuation. That's a whole separate analysis, and I won't dive into that for here. Others I think are going to. And this is not a deep dive into the nuances of preferred stock provisions. That would take a much longer time than 15 or 20 minutes. But they are important. Okay, and a few assumptions going in. Any investor, I believe, has to be very passionate about their investment, because nothing's perfect and there's always bumps. And this is, as others have said, this is like a contact sport. It's not for the faint of heart. So a term sheet can help avoid things that would make the bumps bigger. But you got to be passionate, and you got to plan on, as many people do, invest in future rounds to get past challenges and to help the company continue to grow. Because again, we are partners with the companies. And you got to believe the products and solutions are exciting, disruptive. There's a clear value proposition. That box has got to be checked. The market is big enough to be worth it for you. And importantly, this background and skills of the founders, match what the company is trying to do, or they've identified, others that, can help them, get there. Okay, so what's important to me? I think at first you got to figure out, is this term sheet that I'm looking at company or investor biased, favorable? And to me, that kind of sets the tone for the relationship. I don't want to, if it's all investor, that could, and it's too complicated, it could screw up future rounds that you're trying to raise, or have a lot of extra negotiation. If it's too company focused, it may not be that great of a deal, all else being equal, for the investor. So there really needs to be a balance. And I think if it is balanced and the entrepreneur puts out a balanced term sheet in consultation with their securities counsel, then I think that'll be very healthy, for the investor entrepreneur relationship. And I can't really emphasize that too much. That relationship is, so important. And with the caveat that investors are not going to run the company, and the management's going to do that, and the board is supposed to give guidance to the management. So it's not about really trying to micromanage the entrepreneurs. It's really about being there to support them when it's needed. And then there's big differences between convertible and priced rounds, as you probably well know. I'll touch on that a little bit. And if it's a priced round, what's the type of security? Typically, it's preferred. At the first round of outside investing. And then another key for me is the option pool. It's got to be, the unallocated option pool has to be sufficient to really incentivize the team. And you really need it baked into the cap table before you invest, so there's no surprises. And then something that's often overlooked is the founder stock provisions. These are things that could bite you when you least expect it. And then board structure and the other kind of advisor structure, that's, I think, really important to help the venture. And then information rights. They're typically spelled out in detail in the stock purchase agreement. They're often in term sheets, but I see them absent in term sheets, which, as one of my most frustrating things in investing is, visibility on the venture. Entrepreneurs are busy; they don't have time to do a lot of communication. Some are awesome at it, and really build a good communication stream with the investor. But I think certain rights are important. And so the investor is not surprised, and it builds trust. So again, when the entrepreneur needs some help, the investors are right there with them. Okay, convertible note versus priced round. So, obviously the big difference in a note is it's not priced, and so therefore you need a valuation cap. And a discount is also standard. Typically it's 20%. Sometimes it's higher because of staged timing of the financing. There are different sort of sub tranches, but you really need a cap, and you really don't want to be financing valuation growth against yourself. Why would I put my money in and then have it priced later if my money has helped create a lot of value? But I'm willing to share part of that value. So cap is really important. And then the other thing is really a clear exit, either from the note to equity or back to cash. Sometimes those are very fuzzy in term sheets, so that they have to be really clear. And you want to avoid the situation where you're the company can just, redeem your note for your cash and interest and move on. You've taken equity level risk without reward. So you have to avoid that. And having said that, I think there should be a bias to simplicity, because again, you don't want to confuse, you don't want to have a lot of terms that will screw up the next round, or the round it's supposed to be converting into, which could be imminent, or it could be a year plus off. And then of course in a priced round, the liquidation preferences really set the table for the future rounds. So you don't want to have goofy structures that are a challenge for new investors and cause a lot of unnecessary negotiation. So you can see a theme here. It's really to make sure the term sheet helps get to the next round. The option pool. Now this is, I'm sure a lot of you have seen that, venture deals, VCs always insist on the option pool, and it's a good thing, right? Because you want to incentivize the team, and you don't want to surprise the investor with a whole issuance of shares, dilutive shares or options that you weren't expected. So the option pool has to be baked in to the cap table at the pre-money valuation. Otherwise the investors are going to get diluted if the pool is added later. And I think management should have a pretty good idea of what the prospective hiring will be between now and the next round. So they should have a pretty good idea of what the option budget should be. So you just want to avoid a surprise and have a very clear view of what the cap table is going to look like. And it really often ranges between 10 and 20. It really depends on the specifics of how many people are already on the team and how many how soon it is to the next round. Founder stock. So this is, to me, this is a big cap table risk factor. I've been in deals where there've been 3 founders and 2 quit, and they each have 2/3 of the stock before the investors, and all of a sudden now you need 2 more people to cover off those talents, and you don't have access to that stock, so you have to issue more stock or options to cover that. And the question is, so what happens to that equity if they decide to leave? And if it's not subject to some kind of vesting or repurchase over a specific period of time, you'll likely have to issue more stock to cover the replacements. And how much did they really contribute to the venture at that stage? If it's especially if it's fairly new, they may not have contributed very much other than some great ideas and maybe some IP or whatever. But is that sufficient if they're going to leave in a year or 2 for them to have all their stock? So and this is not just between the founders and the investors, it's also good for the founders between themselves. So, and typically they'll, counsel will make sure they have some kind of a buy-sell arrangement set up so that if this happens, either the company can get it back or buy it, or the other founders could, or some right of first refusal. So anyway, to me, this is really important to mitigate the risk of founders departing from a cap table perspective, not to mention the disruption to the venture itself, of having to scramble to mitigate the impacts of it. And parenthetically, I'm cheating a little bit. Brianna said 5. This is sort of a quasi 6, but I'm going to tuck it in here. Is just make sure all the IP is assigned to the company. So, worst comes to worst, in an exit, if the core value of the company is really the IP, at least there's something there. If you don't have the IP assigned to the company, the inventors of that IP own joint and several rights to it. So any number of them could leave and use the same IP and start new companies, and they're fully within their rights to do that unless it's assigned to the company. So really critical. And of course, all employees need to sign proprietary information and invention agreements. So that's my cheat 6 point. Board structure. This is a little hard in some deals, and I've gone in deals where the board structure is not really clear, particularly if it's early in a convertible note. But it's super important, and it has to be a point of discussion, and there should be a plan for it. And investors really need to have some kind of input in terms of some kind of voting rights, or a representative of the round should have a voice, on board input and the size of the board. I think it's so important. Investors and board members and entrepreneurs, what we all know is what we don't know, or we don't know what we don't know. So, we're really here to help each other figure out what it is that we don't know, and help each other find out what it is and how to get to know it and deal with it. So board members can be super helpful there in the governance, recruiting, financing, and their specific experience. So it's on a case-by-case basis what a company needs, but a healthy board is a good thing. And again, boards should not micromanage companies. It should be a really healthy balance. But it's an important conversation to have going into a deal, or at least be aware of the risks of not having the board structure nailed down. So you might be surprised at information rights coming up in my top 5. It's more of a pet peeve for me, but in most of the investments I do, I think the communication could be better. I mean, there's some exceptions, and they're wonderful. And I, as an entrepreneur, I have not been perfect on this, but I think it's really important for the angel investor to understand what their information rights are. Again, you're not trying to micromanage the company. It does not need to be burdensome. In fact, what the information really should be some information that's already prepared, and it's some subset of what's already used internally, to manage the company or for reporting to the board. So, and I think the dividend here is, the open relationship, the communication contributes to trust, and that trust is really important for the investor to have with the entrepreneur, so that when the next round inevitably comes, the trust is there and no surprises, and it makes that next round funding much easier. So these are often rights written in. They're often, given more to the bigger investors. I would just try to scale it down so it's, at least you have some good visibility, into what the company's doing. Scale it down in terms of the number, the amount you have to invest, to get some investor rights. And from the company point of view, you don't want to be spewing super confidential data out, all over the, investor community, but you want some enough to, have some transparency and build the trust. So this, some final thoughts, and I'm happy to take a few questions if we have time. But this is my high level, overview. So naturally, you all have, and you should dig deeper. I'll show you some resources at the end that I think are helpful, and that I encourage you to refer to. I guess I should change this to OK a seventh. I'm cheating again. Some right of first offer to purchase pro rata any new equity securities could be really valuable to the entrepreneur when the venture takes off. And the old saw is that when you got to feed your winners and starve your losers. You don't want to cut off your opportunity to be able to get in on the next round if the company is really taking off. Again, a lot of this is negotiated, but I would be conscious of what the right of first offers are. And probably goes without saying, but this is sort of ties in with a passion for the company. It's really, regardless of what the terms are, the character of the entrepreneur and how that forms the relationship with the investor really drives the outcome for the investor, in my opinion. And a few resources. This might be a little hard to read, but I'll give this to Keiretsu team to circulate if you want. But I think Brad Feld has done a lot in this area. He's very very smart about it. He's a famous investor, and he's also done a blog. There's some archives. So this is a book, Venture Deals: Be Smarter Than Your Lawyer and Venture Capitalists. There's some term sheet thoughts he did a long time ago that I thought were really good coverage of all the term sheet elements. One of our fellow angel groups, Alliance of Angels, Dan Rosen, did a good analysis of a term sheet. You can download it at this link. And of course, the National Venture Capital Association has a model term sheet. That's a good legal document. It's really helpful, and it's good to have for entrepreneurs when they're talking with their securities counsel, to go through their term sheet. It's a pretty complete, fairly complex, but it covers off a lot of options. I think it's a good reference doc. And of course, your securities attorneys, I'm sure, are like the Carney folks. They deal with this every day, so they'd be helpful. If anybody would like to reach out, you can use my Ascent email, byron@ascentpartnersgroup.com. So thank you very much for letting me share some of my thoughts, and